Today's Talk About It Tuesday question is, how do you start to invest later in life after 40 to 50 and still make gains? Well, listen, you're going to make gains no matter what age you are. The question is, are the gains going to be sufficient for what your goals are? And so maybe you have to adjust your goals and you have to adjust your investing style, but it's never too late to invest. So let's look at the whole premise of investing. The value of investing is about time in, not timing, right? Timing is when you trade or when you do, short-term capital gain things. But for investing, the value is time in. So let's just talk about when we say time in, why is the value time in? One, the longer you can invest, the smaller amounts you have to invest to get the outcome you desire, right? So you can, if you have a long time horizon, you can put in smaller amounts of principal over a longer period of time to get a desired outcome. Why? Also because of compounded growth, right? So compounding is exponential growth as opposed to linear growth. And the more time you have, the greater the compounding effect, which means the greater the exponential growth that you have. So that's another factor why we use the term time in for investing. The third aspect of it is we go through economic cycles. Inevitably, I don't care how great the economy is, it's going to decline. I don't care how bad it is, it will recover. So the more time you have, the more time you have to recover from the down cycles. So now all that is under stress when you talk about starting to invest later in life. So let's just use 50. You said 40 to 50, but let's just start at 50 years old. Obviously, you have less time to invest because the average lifespan in the U.S. is 77. So if we say the average lifespan is 77, then at 50, you're talking about 27 years probably till that's it, right? The average retirement age, some say 64, some say 67. So let's say 65. Average retirement age is 65. Means you have 15 more years of earned income of working probably. And then from 65 to 77, you have 12 years. So you really have to plan, right? If you're talking about investing, you have to plan for 12 years, right? You have to plan to have income for those 12 years. And we said, so we know our time horizon is 15 years and we're planning for 12 years, but now we have to consider what our goals are for those 12 years. And here's where I think people drop the ball. I think people think of investing, especially for retirement, if that's the goal, is that they'll have so much money that they can live off whatever an amount of money is that they have left. And I think that is the error. I think we have to change the investing strategy. We're not trying to have such a large savings that we draw on the savings every single year until it's down to zero. I think the goal is to be able to, yes, create a huge surplus of cash, but not that we draw on. But I think, and I shouldn't say cash, we have a huge amount of valued assets, but those assets should be income producing, right? So, there's these age strategies for investing in terms of stocks and bonds. I think we need to well diversify the portfolio to cover that third aspect of it, which we said we go through these economic cycles. If we talking about a 15-year time horizon, the average recovery time or growth time is 5.5 years in the economic cycle. The average recession time is 11 months. So we'll probably see 2 to 3 of these cycles. We don't have a lot of opportunity to lose during those recession times. So we're going to well diversify so that we create income explosion in the growth times and we can maintain some decent income during the recessionary periods. So when we look at a strategy, I think, again, we need to be considering trying to get 11% average return for the next 15 years, right? So if we look at 11% average return for the next 15 years, if you can use your tax return, take whatever savings you have in the bank, whatever, and come up with $10,000 to start as the principal, well diversified. And when I say well diversified, I believe you need to be in real estate. I believe you need to be getting interest income and dividend income, because those are income producing things. So you're in different asset classes and equities. You're in and I don't like bonds, but other forms of interest income, and you're in real estate. So if you're in those three, at least those three those three asset classes, and you're in there, and they can get some capital appreciation, but also give you income, I think you're in a better place. So again, we're talking about 15 years. If you can average 11% at 15 years, putting in 10,000 once and 1,000 a month, you'll end up in that 15 years with an asset value of over $480,000. So now, when you come out of this, you got $480,000 in value in terms of your assets. You should be in a place at that point where your expenses are lower, right? So that means hopefully you've paid off your mortgage. Hopefully your kids are grown and out of your house. Hopefully you've gone past that stage of frivolous spending on material things. Hopefully at that point, you also have, you're at a better place in your job, so your income has actually increased. And hopefully you've set yourself up so that you have a pension and Social Security. So if you have those things in place, Social Security, pension, and you decide to leave at 65, now the income that you've been, the assets that you've been building over 15 years that create income should be at a point where it supplements what you have in place, your Social Security and hopefully your pension, at a lower expense rate every month. So it should be able to cover it. If not, now, even then, you don't have to put as much principal into your investments. Now you can bring that down, which gives you a little more cash flow every month. And you can start drawing a small amount, maybe 10K, even 20K. You can start drawing 10, 20,000 from that principal of your asset value and live a very good life. So is it possible? Absolutely. Is everything compressed? Absolutely. Do you have to put in more principal to get a decent return? Absolutely. Can you take bigger risks on investments that give you a much better return on investment? No, because again, you don't have that recovery time because your time horizon is compressed, as opposed to somebody who's 30 or somebody who's 20 who has decades to be able to, to do that. And if they have a fail, to be able to recover from it adequately. So you definitely can, but you definitely should not procrastinate. If you're in the 40 to 50, in 40s, please, you have plenty of time. I shouldn't say you have plenty of time. You have a lot more room to gain a lot more money because you have at least an extra decade. But don't wait, because even 40, right, you could have done a lot better had you been in your 30s. But if you're in your 50s, even if you're in your 60s, it's not too late. You still need to invest because it's better than not investing. So hopefully that makes it easier for you. In terms of specific investments, you probably have to figure that out based on your needs. But safe routes, I'm not even going to get into it. So that would take a good consultation with a good financial advisor to put you in the exact thing. But at least you know how much you need to get out. You know what target return you're looking for, and you know your time horizon. So you can actually sit with somebody and they can actually fill in the blanks for you on that. But I'd like to hear your strategies, and if you're in your 40s, 50s, if you have already started investing, if you haven't, what your strategy is, when you plan to do it. But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.